Hi everyone, I'm Jiarong Zhang from Group 44. I would like to share the part B. In the part of introduction, we should focus on two keywords: industry momentum and backtesting. Through purchasing rising industries and short declining ones, the aim is to enhance return and manage risk and help investors refine it continuously. This strategy focuses on the return delta of certain industries and its market returns and risk-free rates. Then, by comparing the average return, the average ranks, the electricity ranks the first, and the telephone one has the lowest rank, which is 70.70 and 14 respectively. By looking at this graph, we know the auto industry fluctuated a lot. Then, calculating the change of the rank of certain industries and collecting them with standard deviation, we got that picture left. The top industry all move around a lot, which means it's a very dynamic strategy influenced by some external elements like economy and some internal elements. We know that they should have a high turnover because they need to adjust frequently and pay some extra commission charges, transaction costs, and need to operate a more complicated management. Then we divide the 30 industries into winner portfolio and the loser portfolio. Here, we know the winner has a larger annualized Sharpe ratio and the loser portfolio underperforms the market. By calculating and knowing all the average monthly return, standard deviation, etc., it suggests that we should consider asset allocation and reassess investment strategy very well. So here, later, we delve into the long-short industry momentum. The annualized Sharpe ratio of it is 0.6101. So, since it's bigger than the market one, if the investor invests the long-short industry momentum, the return of this portfolio is higher than the market. The market delta is negative 0.04, representing a sensitivity of it to the market and the systematic risk. If the market increase one portfolio will decrease 0.04. The t-statistic of market beta is negative 2.38, which is bigger than 2. So it's significantly different from 0, indicating that it's not totally hedged. The monthly alpha is 0.0049, and the t-static here is 5.82. And the annualized alpha is 0.0584. Later, we get the graph of cumulative return by collecting the winner, loser, long-short market portfolio. They all share the same trade and grow a lot during that time. The winner performed the best, while the loser performed the worst. And in the year of 1932 and 1933, the global economy depression was at its peak, making all the industries and the market drop dramatically. Then we focus our attention on the year 2009. The big loss month is from March to May, and we may consider why the market performance well, but the portfolio lost a lot here and here. So in 2008, the financial market was in the recovery stage. And during that time, some industries were very popular in winner portfolio, which tend to have a lower risk, while some industry in loser portfolio tend to have a higher risk. Then, however, there was a market rebound in the beginning of 2009, like some US blowout attention, quantitative easing. So many investors perform together better to get more return after losing a lot. They tend to short sell more. The market rebound causes the loser portfolio to perform well immediately, while the initial winner could not adjust rapidly. So it might cause some losses here. Later, we might consider that n equal to 15 is not the best strategy. A smaller n may work well. So we assume the range of n from 1 to 15 and then calculate each annualized Sharpe ratio. Here, it ranked the first. So n equal to 12 means the best strategy. In the end, we know that we should meet the investor's goal of help identifying and utilizing relative performance difference, thereby achieving high returns and effective managing risk as what I mentioned before. It teaches investors to change investor strategies when facing different financial strategies. That's all. Thank you for listening.